Welcome to this quarter's Economic Update. With me today I've got Will Hickson, our investment advisor from Morgans Financial. So Will, how was this quarter for share markets? Because reviewing clients' portfolios, it looks like it was a really volatile quarter.
Yeah, it was, Justin. The Australian market had a very strong start to the year, but from its peak in January, it's fallen about 5% through February and March. So, look, that would make it one of the most volatile quarters we've seen for a while. Over the first few weeks of April, we've seen things start to generally revert back to some sort of normality, but yeah, it was a tough quarter for share markets and Australian share exposures and client portfolios.
Yeah, well, we contacted clients in February to explain why the market had been so volatile. So maybe just a quick recap on those conversations.
Yeah, sure, Justin. Look, what we've been saying for some time is that inflation looks set to continue or set to return in the US, and that's what's happened. So rising inflation means rising interest rates. Interest rates have been very low for a long time in the US, so the potential for rising interest rates there has been met with some volatility, basically, and look, rising interest rates aren't necessarily a bad thing so long as they happen gradually rather than rapidly. So look, as you can see from this chart of the ASX over the last 3 months, markets started to recover after the initial shock. However, with a few tweets, Donald Trump managed to put markets on the back foot again. He's been unhappy with the US's trade terms with China and wants to improve those. So look, the political risks here seem to be subsiding now, a few weeks into April, but Will Douglas talks a lot more about that in a longer form economic update.
So would you mind just giving a broad recap of asset classes as we've seen them over the last quarter? Yeah,
absolutely. So if I had to sum it up, I'd say Australian share market was weaker, so Australian allocations were weaker on a capital front, but it was a big period for distributions, big period for dividends, so lots of those hitting bank accounts this quarter. International share allocations have generally been excellent performers and held up well through the quarter, which was great. Property, fairly stable after a volatile December quarter, and fixed interest, look, a slight dip, but relatively stable fixed interest.
Yeah, and well, as you say, dividends aside, when I'm reviewing clients' portfolios, it's the international share holdings that are really holding up and outperforming on a capital growth basis. And can you just talk us through why that's happening?
Yeah, absolutely, Justin. So look, particularly over in the US, companies have seen strong profit growth over recent years. So growing company profits is what pushes share prices higher over time. So this past quarter, US company earnings were exceptionally strong. In fact, something like 80% of US companies beat analyst profit expectations, which is an incredible result. I mean, here's a chart just illustrating that, and as you can see, our forecast is for continuing improvement there as well. So look, this is one of the major reasons why generally we've seen international share exposures outperforming in portfolios. Australian companies aren't reporting anywhere near the sort of profit growth that we're seeing over in the US.
And Will, are there any positive Australian market movers over the quarter? It seems that commodity businesses like BHP have really been the better performers.
Yeah, look, Justin, I mean, there wasn't too much that was spared. It was probably a case of companies doing better than others in terms of not being down quite as much. But look, BHP and other commodity businesses held up better than most. So here's a chart of BHP. That rising inflation that I talked about earlier, that's really good for commodity prices. So we've certainly seen better performance from the commodity businesses like BHP, Oil Search, Woodside Petroleum. They've held up better, and look, we think commodity businesses are going to be the better performers for the foreseeable future.
And were there any widely held Australian share companies that were, laggards in most people's portfolios?
Yeah, so Justin, Telstra's been a notable laggard in some portfolios. I mean, here's a chart, and it's not a great picture in the short term. So the company recently had to cut its dividend. It's not only earning any less profit, but it's decided to pay out less of those profits as a dividend, and that's caused some concern in the investment community. So basically, people are concerned around the future of the company under the National Broadband network. So as that rolls out to full coverage, the NBN is going to put Telstra on more of a level playing field with other telcos and sort of question their competitive advantage. But look, we think what the market's not appreciating is how strong a position Telstra will have in 5G, where speeds are going to be something like 6 times faster than the NBN. It's pretty extraordinary. So we see that as a real game changer over the medium term, the next few years. And look, Telstra's paying a 7% fully franked dividend at these prices, which we see as sustainable going forward for the next few years.
So we've seen this chart before, but it's a good illustration of where we think we are in the economic cycle. Economic conditions look good, and we still feel we're in the recovery phase. We're still really comfortable with the outlook through the rest of the year, but the main message for clients is that while the economic outlook is broadly positive, we should be prepared for greater levels of volatility due to the rising interest rates. In other big news from the quarter, Bill Shorten has announced a proposal with regards to franking credits. So based on his proposal so far, it's possible that some clients could lose the franking credit benefits that they receive in their superannuation. His initial proposal has already been watered down and a few times, so it's difficult to speculate as to how we think it'll pan out. But I think it will hurt middle Australians' retirement incomes, and it will force retirees to dip into their capital to make up for the lost income from the franking credits. And perhaps an unintended consequence is retirees will be pushed onto the age pension sooner, increasing Australia's overall welfare liability. In short, there's a lot of water to pass under the bridge before something like this gets enacted, but we'll be in touch with any further developments. We hope you've enjoyed this quarter's economic update, and we'll talk to you soon.